Welcome to PhillipCapital Weekly Market Watch. I'm Lin Sin from Unit Trust Research. Today, we will be going through some key points which mark the end of the recent US fiscal drama. President Barack Obama signed into law a bipartisan deal approved by Congress earlier on October 16 to reopen the federal government, hence ending the 16 days partial shutdown and avert an unprecedented debt default, at least for this year. The measure approved funds the government through January 15 and suspends the debt ceiling until February 7. The temporary fixed debt does not resolve the budgetary issues, which caused a tense political standoff between the Democrats and Republicans. The law commonly known as Obamacare remains intact. Nevertheless, the agreement includes a measure of income verification for those receiving subsidies under the Affordable Care Act and a provision for the Secretary of Human Health Services to submit a report no later than 1st of January, detailing the verification process. The department's Inspector General will submit to Congress no later than July a report on the effectiveness of these procedures. So, what has been changed? Other than it urged the establishment of a cross-party committee of legislators tasked with crafting a long-term budget deal and reporting back to Congress no later than December 13, essentially nothing has been changed, except for unnecessary damage to the US recovery, which was previously sailing smoothly, as well as causing some unnecessary disruption to the global economy. The 2-week-old shutdown was, quote and unquote, yet another self-inflicted crisis, as how Obama puts it, as it witnessed economic growth and hiring slowed, and is likely to shave 0.6% off fourth quarter growth, which is equivalent to taking $24 billion or $1.5 billion a day out of the economy, according to the ratings firm Standard & Poor's. 800,000 people were furloughed, which many were forced to delay spending. Reputation of US was jeopardized. Credit rating was at risk. Consumer and business confidences tempered, and Republicans to be viewed more unfavorably according to a national survey. With economists trimming the US GDP growth outlook for Q4 and labour market which is less likely to improve to such great extent within a month, that is, to reach the forward guidance target rate at least below 6.5% when employment rate was at 7.3% in August, it is deemed unlikely that the Fed will decide to start QE tapering in the October FOMC meeting. Nonetheless, there is still possibility that the Fed will begin to unwind its asset purchases in the December meeting. The short-term resolution is merely kicking cans down the road. Nevertheless, reducing the risk of default could help lift sentiment and boost economic activity over the near term. S&P rose 0.66%, closing at all-time high set September 19, while Nasdaq Composite Index gained 0.62%. Over 80% of stocks traded in NYSE rose. The Dow Jones Industrial Average slipped 0.03%, weighed by IBM and Goldman Sachs. Dollar fell while treasuries and while stocks indexes gained. MSCI World Equity Index, tracking shares in 45 countries, rose 1%, hitting a 5-year high. European shares ended 0.2% higher. Once the initial euphoria has worn off, it is suspected that the investors will begin to focus on the short-term nature of the deal, which means that another shutdown is possible early in the new year. said the chief US economist at Capital Economics. However, with lawmakers trying to find an agreement on how to replace this year's across-the-board spending cuts with more orderly deficit reduction and the impending midterm elections in 2014, the odds of averting another possible standoff next year is quite positive. Having said that, there's no guarantees of anything. Despite following the herd during time of uncertainties, investors may wish to stick on to their large cap stocks or invest into funds with bottom-up strategies, as these companies tend to ride out storms with their strong fundamentals. Investors may wish to hold some liquidity or to invest in money market funds, as well as gold as risk diversifier. Investors may also consider to hold some bond funds, which are perceived as safe haven in such circumstances. Before ending this week's commentary, I would like to share with you the infamous quote from the billionaire Warren Buffett, when he said he doesn't think the federal government will fail to pay its bill, but if it does happen, it's a pure act of idiocy. He added on saying that creditworthiness is like virginity. It can be preserved but not restored very easily. Thank you for watching this week's market commentary. We will see you next week.